they're alternatives, so we can't be benchmarked. I think that's what most investors have to understand. There are different types of long short.
Hello friends, like the quote behind us conveys that every investor is master of his own fate, we also believe the same, and this is our endeavor to ensure that all our clients take informed investment decisions. In the same pursuit, today we have amongst us a prominent fund manager, Mr. Vijay Kumar, who manages a very less understood category of equity funds, which is long short funds. So today we will understand from him in detail what are the long short funds, who are the right investors for this category. Over to you, Mr. Krishnan.
Thank you so much for having me, Kamal.
Our pleasure.
I've been an India-focused equity long short manager since 2006. I've been a fund manager since 2001, FSA-regulated fund manager, managing global equities. But I've been doing India-focused equity long short investing since 2006. I think the scope for long short equity investing in India is massive.
Right. So I would like to understand from you, what is the exact strategy behind fund management of long short funds? What are the type of funds? So how do you what is your day-to-day activity? How is it different from other type of investment products?
Every long short fund, firstly, the most important thing you could understand in equity long short is it's a very generic classification. It covers fund managers with different styles. But principally, there I would say 3 to 4 different styles of long short. Firstly, the most commonly associated are market neutral long short managers, where their long exposures are more or less equal to their short exposures. Hedge fund parlance, as we say, your net exposure is zero, whereas your long exposure minus short exposure is equal to zero. Then you have low net to moderate exposure managers, where the net exposure can be anything between -20 to +40%. Here, the idea is to again run a long short fund, but with less exposure to net equity. Then finally, you have variable net exposure managers, where the net exposures can be anything dependent on what phase of the cycle you are. Whether you're in a bull phase, then you would have a more tactical high net long exposure, or if you're in a bear phase, you would be more net short. But so there are different styles, and every manager is different. And the important thing to remember is, by its very definition, we are alternates. They're alternatives, so we can't be benchmarked. I think that's what most investors have to understand. There are different types of long short, and it's very important for investors to evaluate what their risk appetite is under each category.
So, can you please elaborate and explain this aspect further? That's why alternates cannot be benchmarked.
So, at its very simplest, if you look at India, I'm not talking about offshore Indian equity long short managers, because they're generally very heavily long biased and not very different from long only mutual funds. If you look at India, we're at an interesting cusp. There's probably about 12,000 crores in India managed under equity long short strategies, compared to equity AIFs about 15 lakh crores, which is obviously a drop in the ocean compared to other geographies. So your simplest example of a market neutral long short fund would be an arbitrage fund,
Right.
where the net exposure is basically zero. Because essentially an arbitrage manager goes long certain equities in cash, and he shorts the futures of the very same underlyings, and he's just looking to earn a spread.
Right.
So that is your strictest definition of a market neutral long short manager.
What is your recommended allocation for an investor as a percentage of his portfolio that should be given to long short funds?
So at the outset, let me like to say that we are not here to challenge the notion of equities and debt as core asset classes. We would advise investors to remain invested in equity and debt through all phases of the market cycle. The idea really is to provide a superior case for alternatives, specifically property and gold. Right? let's take the example of gold. I know I'm going to get a lot of brickbats over this, but why do we need gold in an era where the Monetary Policy Committee clearly has a positive real interest rate bias? In fact, our
last 1 year, has not been very great for long-short funds,
right,
because it was a tough year, and maybe as you rightly have conveyed that in tough times, long-short funds have shown their endurance, which is kind of what was expected out of these funds.
Right.
But what are the kind of times that we should kind of expect when we can see long-short funds actually delivering the returns superior to maybe their benchmark or superior to a good debt fund?
Right. So there are a number of factors. Manager skill is also very, very important in this business. It's the most important factor, right? If you're allocating with a long-short manager, the long-short manager can't hide behind the excuse that the market fell or the RBI did this, that, or whatnot, right? It's down to you. So if you don't generate positive P&L, it's down to you. So that's the first point. The second point is you have to see how well aligned the manager is to his own product. Is he eating his own cooking? So I invest in both my long-short products. So when my investors feel the pain, I feel it too. I feel it first. Now coming to your point on alpha generation, so there are a couple of different ways of looking at this. Firstly, the manager has to pick the stocks and sectors which he thinks are going to outperform. He's got to pick the stocks and sectors which he thinks are going to underperform. And he's got to manage his net exposure within the predefined product profile of the fund, be it a conservative, market neutral, or a more aggressive tactical. And again, the second part of the equation, the so-called market timing alpha, is always a very, very difficult concept, because market timing is a challenge for anybody, even global macro managers. Over time, India is a fantastic growth economy, and you don't have anything to take away from that. But if you think about the value-destroying themes that we've had over the past several years, we've had telecoms, we've had industrials, we've had PSU banks, we've had one airline, and I've managed to write some of these on the short book to some extent. You can think of the kind of alpha generation that you have, and that's what really translates into superior performance. It's all about risk-adjusted return and giving investors better return per unit of risk, and your correlation and your net exposure and how much you fall versus the market is a key determinant of that.
So basically, you are saying that the core aspect is the knack and the skill of the fund manager.
Yes.
And if longs and shorts both are working, and one gives,
they don't always work. They sometimes work the other way as well.
Right.
But that's just part and parcel of the game.
Right. So, but if they work, then over a 3-year horizon, one can actually get great returns.
Yes, I would say superior risk-adjusted returns. I wouldn't like to say great returns, superior risk-adjusted returns. Because what we have, it's a global phenomenon,
right? And
it's going to happen in India as well. Increasingly, active flows are being challenged by passive flows, right? So, but an interesting thing about when you look at India is there was a Wall Street Journal article recently that spoke about the persistence of manager alpha, and India actually ranked right at the top. Right? So my point to you is, if there is so much alpha persistency in long-only managers, why is there not enough? Why are people also talking about persistency in long-short managers? Because if there's alpha on the long side, there should be alpha on the short side as well. That's how returns are distributed. That is our basic premise.
So long-short funds are meant to generate superior risk-adjusted returns.
Yes.
The principles of accounting and valuations which are used for buy-only strategy are the same principles used?
Well, it depends on the manager. So we are basically bottom-up traditional investors. So we run quantitative processes, more fundamental and forensic research where we take apart balance sheet and understand what the company is really about. Finally, we have to value the company because valuation is central to what we do. And if we think the company is undervalued, then it goes into our long focus list.
Right.
We run screens on the short side, and here it's the same funder. You're trying to find companies which are grossly overvalued to what you think they are. What you think they're valued. They might also have broken business models, have too much debt, aggressive accounting, whatever. There you're looking for catalysts. You put them in a short focus list. At any point in time, our long-short portfolio is a subset of our long and short focus list. So we are bottom-up investors. The art of investing is the same. But long-short strategies can be run based on any framework. So it's very important not to get mesmerized by the term long-short. But what kind of investor are you? Are you a bottom-up investor? Are you a macro-thematic investor? Are you a quant-based investor? Long-short is only the risk of that.
Right. Right. Pleasure talking to you.
Thank you very much, Kumar.